Hello everyone, it's Steve McClatchy here from Loans Australia. We'll be starting in a very quick moment. Welcome aboard, and I'll be back to you very, very shortly. Here we go. As people are joining us now, look, I'm going to kick off and get going. My name's Steve McClatchy here from Loans Australia, and we are very delighted to welcome you to our first ever Loans Australia webinar. I'm very excited to start this process. Over the years, we've done lots of workshops and seminars, but never a webinar. So this is very exciting for us. This is our first one. We're going to endeavour to keep these always to less than 30 minutes so people can log in quickly and grab some information on their lunch break. That's our plan. And obviously, we welcome any feedback so that we can change things up as we move along as well. Today, we're just going to focus on one particular topic, 13 ways to turbocharge your borrowing capacity. As you'll see, Loans Australia specialise in dealing with investors, and for investors, it's a key point. You want to grow as fast as you can, and the key to doing that is borrowing money, and that's what we specialise in, of how to extract that extra dollar out of the banks to get you ahead and into your next property as fast as possible. Now, in terms of who Loans Australia are, for those of you who don't know us or haven't dealt with us in the past, we specialise in dealing with property investors who have between 2 and 29 properties. We're not like a no-name brand where we just punch a couple of figures into a computer and out spits a borrowing capacity. We take our time, a strategic approach, and put together a proper plan for our clients to show them how they can move forward into the next property and forward. We specialise between 2 and 29 properties. And at the end of the day, we want to deliver tangible results. Otherwise, if we can't do that, then there's no point using a broker. So that's what our goal is, to help you move forward as quickly as possible. In terms of why you should listen to myself, Steve McClatchy, that's important. You want to know that I've got a bit of a background and know what I'm talking about. Otherwise, we're not going to deliver sustainable results for you. Now, in terms of my background, I am actually qualified, and people say I don't worry about that, and you're not qualified, but no, we are here, so you can rely on what we're talking about. We've got a commerce degree, and I've got a graduate diploma in applied finance and investment, so quite a few different qualifications over the years, and I've decided to go and get our own Australian credit license, which I've done. So unlike a lot of people who are licensed under another group, we actually have our own directly with ASIC, and that means with lots of guidelines we've got to follow and accreditations we have to keep up, which we do each year. And we do attend many professional development courses to make sure that we're ahead of the game in that regards. So we are qualified in what we're talking about. In terms of my career myself, I've been self-employed for basically my whole working life, the last 22, 23 years. So I started off with National Mutual, a very large company in the risk insurance area, and quickly added financial planning to what I was doing. I was more interested in the wealth generation part of the whole equation. Very early on, I actually got exposed to home loan lending via a little tiny company back at that time called Mortgage Choice back in 1995, when they were just one little office up in Sydney. I joined them then. They weren't a big franchise group at that stage, and that's where I learnt the ropes. And that was very good and very quick learning process. From there, I added on financing equipment and cars and commercial lending, and in the last 10 years or so, development finance, which I have a passion for as well. So really, since about 1995, 96, finance has been the main focus, and I sold my financial planning business in 2002. So I had a large company before and found that was too time-consuming and running between Sydney and Melbourne each week. So now I'm happy around the 10-team level, which is a great result for our clients, more time with them. In terms of the background, we specialise, as I said, in creative financing. Over the years, we've written a lot of loans. Been adding those up. It's up to nearly about 800 million in lending. So we've done a lot of lending. So we know what we're talking about in that regards. I've done a lot of speaking on finance, not just in Australia, but also in Indonesia, Kenya, and the US. We've got a division called Loans USA, which specialises in organising finance for foreigners buying in the US, which is another business altogether. So I've done a lot of speaking in that area. I myself have bought a lot of property, both in Australia and overseas. So we have an investor's mindset, which is critical if you're going to help other people grow their portfolio. It's good to know that you're actually doing it as well. And that's why, if the loans not going to or the bank, or they're asking more questions, we generally know why. When you go directly to a bank, often they won't even tell you what the issue is. So we know what we're talking about in that regards. Interesting for us, and we're very happy to be publishing our first book on investment finance the next couple of months, which is great. We're looking forward to that. Just putting some of the information we've put together over the years together to get it out there more in the public and helping people out further in that regard. So that's very exciting for us over the next couple of months. This is our team that people deal with on a day-to-day basis. There's myself up the top, and also Andrew Saltry and Tony Winder, our finance strategists, and they deal with our clients to work out a strategy which is going to help them move forward as quickly as possible. That's our focus. We want to either help people borrow more money or help them minimise the cost of holding their portfolio. That's the thing that's holding people back a little bit, maintaining that. So once we work out a strategy with a client, we work then with Sandra and Christine, the two ladies in the middle there, to put together a report. So every client we work with, we put together a strategic report in writing so that everyone knows and are on the same page and look at the same sort of information together. Once a strategy's approved and agreed upon and we move forward, then once the loan's in the system, then Olivia then controls that loan process with our lenders and keeps everyone up to date and make sure everyone knows what's going on. The communications are very important at that stage of the process. Claire down the bottom there looks after our marketing and overall business management, and then Peter also looks after our loan administration as well. So that's the internal team. In terms of today's main topic, 13 ways to turbocharge your borrowing capacity. We're going to have a look at the first one, which is quite straightforward really, consolidating shorter term debt into longer term debt. Now that's very obvious. The whole idea there is obviously if you've got a series of debts like credit cards and personal loans or car loans, that can severely inhibit how much you can afford to borrow, because obviously you're paying that debt back over a short period of time, like 5 to 6, 7, maybe 7 years at the most. If you can then refinance that or put that into your mortgage over a 30-year or 25-year term, means your repayments are going to be less, and therefore you can borrow more money for investment. My focus is on how much more you can borrow for investment, not so much the interest you're paying on that little bit of debt that you've got, because you'll make a lot more money by being able to buy another property in that doubling in 10 years or so, than you would be paying a little bit more interest over a longer period of time on these small car loans or something like that. The second tip that we do a lot is reducing credit card limits. Now, the main thing with credit card limits, we're finding more and more people have got bigger and bigger limits. The banks are automatically, these days less so, but increasing the limits over time. And every time you increase your limit, it's inhibiting how much you can borrow. An extra $50,000 in borrowing capacity can make a massive difference. To give you an idea, someone on an income of $60,000, just with a $20,000 credit card limit, if you got rid of that limit, it will give you borrowing another $85,000 in capacity, which is a lot. We're talking about trying to build your credit, trying to build your borrowing capacity. So some lenders out there will actually, if you can prove you're paying off your credit card every month, will actually disregard that limit. So that could be a plus. Or other ways of doing it, you pay out your credit cards now, then in the future, open up another credit card down the track. That can help short-term measure as well. The third point, paying off your bad debt first. This is going to increase your borrowing capacity for good debt. So bad debts like your home loan, where you can't get a tax deduction for it, or car loan or personal loan, whatever it may be, however you're doing it. Let's try and hoe into that, get rid of that, so you can actually borrow more money for investment debt, which is going to grow in value and be able to obviously get some tax deductions if you need to along the way as well. So they're quite straightforward tips there. So we'll get into a bit more ones that are going to push the envelope a bit more. Number 4, pay interest only on your home loan. What people don't realise, even if you're paying interest only on your home loan, you can pay an unlimited amount of principal off that as you go along. So you're not restricted, like some people think. You can pay as much as you like, but by having the minimum payment interest only, some lenders will actually just base your servicing on the minimum interest payment. That means you can borrow a lot more money than what you normally could if you're paying principal and interest, especially if you've already got 3 or 4 different loans. That has a massive effect on how much you can borrow. We've seen great results with that. So don't just have interest only on your home loan, on your investment loan, try and have it on your home loan as well. That will certainly enhance your borrowing capacity. Number 5, all lenders treat income differently. Some don't include bonuses and commissions, and there's lots of different things. Salary packaging is an interesting one. government allowances and casual income, they're all treated differently by the lenders. So unfortunately, if you've got all your lending with one particular lender, and let's say they don't, you change your job and you move from full-time to casual, and that lender doesn't take into account casual income until you've been doing it for 12 months or 2 years, then all of a sudden you can't borrow any money. And for some people, I think if the bank says no, well, it's all over. Unfortunately, that's if you don't look around, that is the case. But the good news is lots of lenders will take into account casual income, even from 1 day in some occupations, and some others in 3 to 6 months of casual income, and then your income can be included. So income, it's very differential depending on the industry you're in, the way you get paid, especially commissions. Excuse me, some lenders won't take into account commissions if you don't receive them on a regular basis. So that has to be taken into account. So number 6, also not only income is treated differently by lenders, also expenses are treated differently. The lenders track what we call living expenses. So they estimate how much it would cost for you to live, whether they apportion an amount as a single applicant, as a couple, and then take into account children as well. So all lenders have minimum amounts that they'll accept. So even if you say your living expenses are $1,000 a month, they might say, no, the minimum we'll take into account is $1,600. Well, that's fine, but if you put down on your application for, oh, my expenses are $3,000 a month, because you haven't, it's just a ballpark figure, and their minimum is $2,000, that means there's $1,000 per month that you've allocated to living expenses, which is inhibiting how much you can borrow. So it's good to take that into account. Also, some lenders now are even asking you how much do you pay on school fees or health insurance and other, even telephone, mobile phones. And if you're putting down all these big figures there, that's also inhibiting how much you can borrow. Lenders won't tell you how they calculate this unless either your mortgage broker or then unfortunately you're going to be borrowing a lot less than what you conceivably can with other lenders. So it's important to understand what you're filling in and it's accurate as you move along. Number 7, split your liabilities with your partner. So sometimes if you're, say, bought a property with someone and you're 50-50, most lenders will take into account 50% of the rental income, but take into account 100% of the debt because you're joint and severally liable for that debt. What we can do is we have a couple of lenders, as long as we can prove that that person has an income and can afford their 50%, then that lender will only take into account that 50% of the debt, your 50%. So that could increase your borrowing a lot. And we've seen that especially with siblings who start out buying properties together for affordability, but then later on they get married or want to buy their own home. That can severely affect their borrowing capacity if they have that debt 50-50 with someone else. So we can look at strategies there. Number 8, you could apply for a loan in an individual's name and not use the living expenses of a second person. What I mean by this is that, let's just say one person is on $100,000 a year, and the second person may be part-time on $30,000. Now for asset protection and also borrowing, you may find that the person or the accountant may advise putting the house in the highest income earner's name for whatever reason. Now, most banks will take into account the living expenses or the minimum amounts for both applicants, even though the first applicant's the one on title and the second person, because they're only on $30,000, they might not need to be on title, need to be a borrower, but the bank will still take their living expense into account. And that may be $20,000 a year, which stops you borrowing more money. We do have some lenders, as long as we can prove that that second person, again, has some sort of income and can afford their basic costs, then we don't need to take into account that person's living expenses, which again can increase borrowing capacity. And not many lenders do that, and not many people I know are aware of that sort of criteria, but we certainly are. We use that a bit. Number 9, if renting, you put the lease in the lowest income earner's name to boost the other's borrowing capacity. Ideally, you have the non-lease renter on the loan. Lenders may ask for proof the other party can afford the lease, which is fair enough. That is an ideal strategy. So if there's 2 of you, one goes on the loan, the other person leases their rental property. That way there we can borrow more money. And look, really the best strategy is if you have a company, try and put your home lease in your company's name and claim that as a home office that way. That way there you don't need to include the rental against your personal situation. And that certainly saves a lot of money, especially if you're paying a couple of $1,000s a year a month in rent. That saves a lot of borrowing capacity. Okay, number 10. Each lender applies what we call a benchmark or buffer rate. What that means is if your interest rate, let's say it's 5.5%, the bank's charging you, that's what you normally pay, they'll add on a higher interest rate to make sure you can afford to pay that loan if rates go up. So what that means is that if it's 5.5, the lenders may add on 2%. So they'll see if you can afford to repay the loan at 7.5. So even if you've got a 5-year fixed and the loan's not even going to change, they'll still apply the benchmark rate. Worst case scenario. Now, luckily some lenders will, if you get a discount on your interest rate, will take that into account with the buffer rate. Some won't, some will. So really it's about understanding what the qualifications and criteria are of the individual lenders you're looking at. Unfortunately, most mortgage brokers don't understand how these policies work. All they do is punch clients' figures into a computer, press a button, and it tells you the borrowing capacity of these different lenders. Unfortunately, a lot of these behind the scenes little niches I'm talking about in policy are not factored into these calculators. So a lot of the time you have to do this manually with the bank's calculators to work out what you can borrow, and it's not figured into the software. So if mortgage brokers don't understand these little calculations and niches, then they'll certainly be borrowing a lot less than what you really can with some particular lenders out there. Because some lenders do definitely focus more on investors than others, and they're the ones that we want to work with and build your portfolio as quickly as possible. So benchmark's really important, and where the issue comes in there a lot is if you've got a lot of properties and every property is being benchmarked. So instead of assessing the rate at say 5.5, you're assessing it at 7.5 or 8%, then certainly your borrowing capacity is going to be astronomically lower than what it could be. And that drives me to point 11. We tend to focus on lenders who use what we call actual repayments as part of their servicing policy. So that means that if you're paying an interest rate of say 5% and it's interest only, they'll actually take that figure into account when they're working out what you can borrow. So even if it's your own home and you're paying interest only, they'll take the interest only repayment. If it was a principal interest repayment, well, they would take into account the principal interest repayment. So they're not adding on another 2% or whatever it may be on top. So this particular method, not many lenders do it, but we have a few that do, and those particular lenders, have massive differences in what they can afford to lend to investors as opposed to some of the other lenders out there. So that's a really important point if you're an investor, that you want to use lenders who use actual repayments in borrowing capacity. Just ask your broker whether they do or your bank, and that will help you. Point 12, don't just use one lender. To maximise borrowing capacity, use multiple lenders. That's really important. A lot of the time, we see it all the time here that we've seen a client, and they've got, say, 4 loans, they're all with NAB or ANZ or whoever. What the banks tend to do is cross-collateralise. That means they link all the securities together and they're all secured against each other in case something goes wrong. The bank's in a very powerful position. Not only that, it severely inhibits your borrowing capacity because a lot of these banks who do this automatically don't use actual repayments. They buffer all their loans. So if you've got 3 or 4 loans with the one lender, they're all being buffered. And when you go for another loan, they say, oh, you can't afford it. They don't tell you why or what you can do about it. And so we have to then go about and unlink all these properties, which takes a lot of time and effort, especially if you've already bought something without a pre-approval, we're getting a bit more strife. So the name of the game is don't have properties linked together, don't have them cross-collateralized, and as you move forward, try and use different lenders. It's going to mean you can borrow more money. It's also going to give you more asset protection. It also allows you to play one lender off against another once your portfolio is a decent size. So that's very important. Number 13, look, if one applicant has a credit issue which prevents or restricts further borrowing, which can happen, look to shift them off title or resign from directorship. This happens from time to time where something out of unforeseen's happened, or in some cases people have had defaults listed, they're not even aware of it. They may have moved house and bills have come to the old house, the mail wasn't passed on, and all of a sudden they've been defaulted. And once you start getting a few defaults, or they're fairly large, over $1,000 or so, then the banks will restrict on how much they can borrow you and lend you. So some of the times, if there's directorships involved, we can take people off as director or put people on if need be, and that's going to certainly help with borrowing capacity. So it's always important. If there's 2 applicants, at least we can potentially use one applicant, not the other one if we need to. I just thought I'd put a couple more in there. One of the documents we put together for clients, actually 22 ways to increase. I've just cut that down for today, but 2 more. We see a bit self-employed people particularly haven't always got their tax returns up to date, and sometimes they like their accountant minimising their taxable income, so that they obviously pay less tax, but that can affect borrowing capacity. Also these days with the low doc loan, most of the major banks anyway will charge mortgage insurance to their customers once you borrow more than 60%. So that certainly does inhibit borrowing capacity if you want to keep your costs down as well. So we always say, look, lodge your tax returns, and because we are experts at understanding tax returns and how we can maximise your borrowing capacity with them, we often find ways to lend you more money. Once we've seen the tax returns, we can work with the accountant on that regard. So that's very important. And 15, the last one, you can consider renting out your house and either board with your parents or take a cheap rental to build your wealth quicker. And this might not be a popular strategy, but it certainly works. At the end of the day, it just depends on how quickly you want to build your wealth, especially if you're starting out. A lot of people are paying very high rent at the moment. So a lot of people find it hard to pay a high rent and also build their property portfolio because so much money is going out the door. So for a short period of time, maybe worth trying to move back in with parents or leaving a cheaper rental. That way there, if you rent out your own home, you're going to get a lot more income for that. Plus, you're going to get negative gearing. So a lot of the lenders will take into account interest deductions on an investment loan as part of your income. That's certainly going to help you move forward quicker to your borrowing capacity. So there's 15 tips we've got in borrowing capacity. Very quick. Today is really all about just giving you a couple of pointers and letting you know these are the sorts of strategies we put in place with our clients to get them moving far otherwise would. A little bit of a market update for investors especially. The government is quite adamant about investment lending and trying to rein that in at the moment. So they've been actually auditing a few of the banks, the ones which are more overweight in investment lending compared to owner-occupied lending. And some of the changes we've seen come in over the last 4 weeks or so is that some of the banks now are actually differentiating between owner-occupied investment lending. They used to do that 15 or so years ago, and that sort of went away, and they're all the same. But now it's sort of come back where they're providing bigger interest rate discounts for owner-occupied loans, which we haven't seen for a long time, but that's now coming back into the marketplace, especially on some of the fixed loans as well. One of our lenders gives a 0.15 discount if it's an occupied loan as against an investment mortgage. And also they're starting to favour some of them principal interest loans opposed to interest only. Now, as I've said in my update, we prefer interest only because it's much better for borrowing capacity, so that may be something that's going to affect you moving forward. So we encourage anyone who's an investor that wants to build a portfolio quickly to consider moving to interest only as soon as possible to obviously maximise your ability to move forward. Over 19 years of doing lending, this is the most competitive time and lowest interest rates I've ever seen. One of our lenders this week's just put out a 3.99% 3-year fixed loan. It's amazing. We've got another loan at 4.09, which is 3-year fixed and comes with a 100% offset account. So it's amazing what's out there and what can be done at the moment. And obviously, we don't just look at rate. That's important, but not the primary focus. The primary focus for us and most of our clients who are investors are what lenders do we go to be able to lend you more money so you can move it a lot quicker. The whole aim of the game is building a portfolio. You don't want to have to build a portfolio over 30 years if you can. You want to get in there and build it as quickly as possible and then let the magic of compound interest work its magic over the next 10, 15 years for you. One of the things that we are doing a lot of, as I said, with workshops and seminars we do, there's a big event coming up this weekend. It's a 2-day event, live event in Melbourne. It's called the Real Estate Investing Fast Track Weekend. I'm the featured speaker at this event, talking about more advanced financing strategies, and borrowing capacity is obviously part of it. It's very important. There's 2 other speakers. One's focused on the starting point of finance, so how that works, the structuring of finance, which is critical to building a portfolio. And there's another person also talking about due diligence in real estate and what to look at and where to look at and how to research properties. That part's conducted on the second day, on this Sunday, by Cameron Fisher, who's the head of Changing Places Real Estate in Melbourne. And then Conrad's talking about the intro to finance and how to structure your portfolio. And I'm talking about a bit more advanced strategies in financing to build it quicker. This event's going to be held at the Blackman Hotel, which is on St Kilda Road in Melbourne. For all our clients, normally it's $97 for the weekend. It's actually free for our clients. That gets you a copy of Conrad's new book on financing, and also a free lunch on the Sunday as part of a bus trip. They take you around and show you different parts of Melbourne and why they're investing there and why you should look investing there, and also how to do due diligence on property. So you just go to the website www.realestatefasttrack.com.au to get your tickets, and the promo code is the VIP free 2 ticket S2015. So do that or ring us and we can help you out with that. So I hope you've enjoyed this first webinar that we've done. Quick, short and sharp, just about borrowing capacity and focus on how we can increase the amount you can borrow as quickly as possible. I want to thank you for your attendance. Any questions or feedback you have would be appreciated, and happy to take your questions as we move forward. Thank you to everyone, and I look forward to speaking to you soon. Thank you.